webinar titled Let the Data Set You Free. Before I turn it over to our presenters, I'd like to make a few housekeeping announcements. First, this webinar is meant to be interactive, and our presenters welcome your questions. Throughout the presentations, you're encouraged to ask questions through the chat box at the top left of your screen. And following the presentations, we'll also open the phone line for your direct questions. You'll be able to ask those questions by pushing 1-4 on your phone, and we will remind you of those instructions at that time. Next, I want to take a quick minute to highlight a couple of upcoming SIIA events. First is our All About the Cloud conference taking place May 23rd through 26th in San Francisco. If you're not familiar with the conference, I encourage you to visit the website, or you can contact me directly for details. My email address is there on the screen. Next is our Strategic Partner and Private Equity Conference taking place July 20th in New York City. We are currently seeking companies to present in front of an audience of potential partners and investors. You can submit directly online with the URL that you see there on your screen. For those of you based in the Bay Area or who travel there frequently, I encourage you to check out our upcoming roundtable meetings. I particularly want to point out the meeting around the topic of revenue recognition hosted by NetSuite on March 29th. Given today's webinar topic, I thought that many of you might find this event also valuable. If you are not an SIIA member and want to check it out, please contact Nate Phillip, whose details you see on the screen. Finally, let's get to why we are here today. The SIIA is delighted to again partner with OPEXEngine on the 2011 Software Benchmarking Survey. In today's webinar, you'll hear about the survey itself, the data in the reports, and how your business can leverage the data for growth and improving operating efficiencies. So with that, I want to turn it over to our first presenter today, Lauren Kelley, CEO of OPEXEngine. Lauren?
Thank you, Rihanna. As Rihanna said, my name is Lauren Kelley. I'm calling in from the UK where, as usual, it's raining. I started OPEXEngine 5 years ago after 25 years as a senior manager and operating executive in tech companies. I started OPEXEngine because there was a dearth of good operating metrics for the software industry, and I had sat in too many executive team meetings and too many board meetings where we were discussing operating metrics and budgets and plans without any good data to compare in our discussions. And public company data is good but not detailed enough, and certainly doesn't cover private or small and mid-sized companies. So I started OPEXEngine as a service. It's not a free survey because we can vouch for the data, and we have a team of accountants and statisticians who clean and sort the data. And after 5 years and 4 annual benchmarkings, we have over 50,000 data points in our database of small and mid-sized software benchmarks, which is what I'm going to talk about today. So I guess first off, maybe we should talk about why benchmark. Basically, the fastest growing and most successful companies tend to be very metrics driven, especially today. It's important to make metrics and benchmarking a key part of company management, especially early on. We've all just been through a major economic drop that hopefully we're slowly coming out of. If your company is just about running as fast as you can in the good times, then you'll probably get lost as the road gets more difficult to navigate. Even the most efficient companies constantly review their numbers and keep looking at areas where they can be more efficient, or maybe where they've cut back too much, as many companies did cut back quite a bit over the last 2 years, and need to put a bit more gas on. By benchmarking your company against your peers, it also helps provide neutral data for your operating heads, heads of sales, heads of marketing, heads of R&D, etc., where neutral data can help everyone get on board with a plan and take some of the emotion, or what I would call decision-making by anecdotes, out of the picture, or at least minimize some of that. The benchmarks also help provide guideposts as business models are changing. For example, Larry Bond, a venture partner at General Catalyst in the Boston area, recently stated in an interview with me that SaaS companies today, on average, are taking half as much capital to get to profitability as 5 years ago. And that's due to a variety of factors, including cheaper hosting through the cloud. Of course, benchmarking isn't a blueprint for the exact numbers that are right for your company. But taken in the context of your particular numbers, benchmarks provide valuable parameters for your operating targets and strategy. So I will mention quickly our annual confidential benchmarking, which Rihanna spoke about in the beginning. This year we're launching it in the beginning of March, and again in partnership with the SIIA. Companies input their internal data into our secure online survey form where data is aggregated and blinded. Each participant receives an individual company report, and let me show you. I know this slide isn't clear enough to really see everything, and the numbers here actually are not real numbers, but just to give you a sense, we break out the benchmarks for small and mid-sized software companies by a whole variety of discrete peer groups, both by revenue size, by business model, for example, SaaS or perpetual license companies or companies with a mix of both revenue models, as well as by sales model. I think it's important to look at the operating ratios for your company and compare them to a peer, for example, with a similar sales model. For example, a company that is selling to large enterprises with an enterprise sales model is going to have different operating ratios than a company that is selling to the mid-market with a low-cost product and a different kind of sales and marketing mix. We also break it out by private and public companies, and then we provide fairly detailed, the benchmarks themselves are fairly detailed, broken out by the major budget groups or departmental groups. We separate sales from marketing. We look at professional services, customer support, and then within each of those groups, the headcounts, the comp and benefits, and then also look at customer numbers, deal sizes, and a number of other business metrics. So if we look at what software management today is really all about, it's about the numbers. I think Kelley is going to describe in greater detail after me how CFOs and CEOs are looking at these numbers and how to manage companies. But especially for SaaS vendors and really for any software company today where the pressure to get to profitability while achieving incredibly high revenue growth rates is intense, especially at the same time as cash flows and access to capital may be limited. I think it's important to look particularly at what stage a software company is at to understand what metrics are important and what the typical operating ratios would look like at that stage. In the early stage, cash is key. In the next stage, where the sales model is established, it's all about adding customers and revenue growth, as well as managing the cost of acquiring new customers and the cost of maintaining each customer. So for example, for SaaS companies, there are a number of very specific metrics around this area, many of which are fairly well known, but we track all of these core metrics. Of course, cash from operations is a key metric and may be considered the lifeblood early on when cash is tight, but later on is also important and can be an interesting metric for acquirers and public markets to see how much cash a company is throwing off. Monthly recurring revenues and change in monthly recurring revenues, hopefully a positive change, are standards for SaaS companies and considered indicators of their success and a predictor of long-term growth and value. New customer growth rates are key, and it's important, obviously, that the growth in new customers outpaces churn, or that's also bad news. Another metric, the cost of acquiring a new customer and the cost to maintain a customer are both key to understand the customer break-even point, which leads then to profitability. And it's important to understand these metrics for similar types of customers. We also track cost of product as well as separately cost of hosting. And another metric that we benchmark is average contract value and average upsell per customer this year. Both of these lead to long-term or lifetime value of a customer, which ultimately can determine the value of your company. I also mention here Omniture's magic number, which is famous as a calculation of how a monthly or quarterly increase in marketing and sales expense can predictably affect an increase in MRR. it's a way to determine if a company really has a predictable model in place, and a metric that's discussed quite a bit in internet blogs about the SAS model, but I think most SAS companies are well aware of that metric now. And we also track churn in two different ways, by the number of customers renewing and also by the dollar value of what's renewed. So for example, over the past 2 years, as the economy was slowing, we saw certain segments of the software industry with slightly increased churn rates by customer numbers, but almost 100%, or in some segments more than 100% renewals by dollar value. And I think that's because these companies in a down market were focusing on increasing sales into their best customers and dropping their least valuable customers. So if we move on, I've thrown in a few of our customer profitability metrics for private SaaS companies from our benchmarking last year, and separated it out by two groups of companies. The averages for companies under 10 million in revenues, so fairly early stage companies, and then the other group, the darker color, sort of purplish color, is for the companies between 10 million and 50 million in revenues. And as you can see, what's interesting is that the larger companies have significantly higher customer acquisition costs, and clearly putting the gas on to go after more new customers. And their customer maintenance costs per active customer is also higher, but then their average contract value per customer is quite a bit higher as well. And I think it's important to keep looking and reviewing those particular numbers. Here in the next slide, I've just pulled out some of the latest releases of some well-known public SaaS companies to show how the market's responding, particularly to very high revenue growth, especially at the size these companies are at. And if you look at some of the companies with the highest market caps, like Concur or SuccessFactors, they've shown very strong revenue growth rates, especially over the past 3 years. So if you're looking at the slide, hopefully you can read it across the top in the blue-gray line. It's market cap. The next line is recognized revenue, then recognized revenue for the prior periods, and you can see the 3-year revenue combined annual growth rates. But you can also look at deferred revenue. So for example, SuccessFactors, which has had a 3-year combined annual growth rate of almost 50%, and coming into this year, 2011, had about 107% deferred revenue, 107% of recognized revenue. And then the analysts' estimates for this coming year are also quite high, so the market is certainly supporting that kind of growth rate. And then in the next slide, some of these same companies, if you look at their operating ratios. And here I think, and I've put in the furthest right column the same operating benchmarks for private SaaS companies averaging about 15, 16 million in revenues. And what's interesting is also if you look at these operating ratios for this variety of SaaS companies, all very successful public companies, they're a little bit across the board. I mean, you'll see, for example, if you just take sales and marketing expense, the lowest one here is Connexa, 24.5%, and then obviously the private companies at 62%, but you see much higher rates, NetSuite at 48%. And some of that reflects just different sales models and also how much they're choosing to emphasize that. Because then if you look at NetSuite, for example, their R&D is 18%, Connexa is only 6.1%. So it's important to compare yourself against companies with similar models, because it can vary quite a bit, even though the size of revenue can be relatively similar. So I think just in conclusion, one thing that's important to note and certainly affects anybody's operating plan if you're planning out is that on average SaaS companies are getting to profitability, and these are venture-backed firms. I've worked with companies over the last 5 years that were getting to profitability. These are bootstrap companies that got to profitability at much lower revenue rates but also had lower growth rates. But these companies getting to profitability at 25 million instead of 50 million. So that's the kind of metric that people are going to be looking at when they're looking at your company. And the other point is that the operating ratios do vary considerably, even within similar revenue and stages. And I think that's determined by the company's strategy and their sales and marketing particularly. And I think the other key message is that the public company filings are useful, certainly, but certainly for company management, but also boards and public analysts are starting to look under the cover at metrics that are not contained in the public filings, and then it's important to have a sense of what your peer group is doing in that area. So I can only encourage you to participate in the 2011 Software Benchmarking Survey. SIIA members are free if they're under 10 million in revenues, only $9.99 for companies over 10 million. And non-SIIA members are slightly more. So if you go to our website, OPEXEngine.com, you'll find out a little bit more information about that. And with that, I'm going to turn it over to Kelley. And Kelley has a really interesting perspective, I think, as a CFO herself, but also being CFO of a very cool on-demand corporate performance management vendor with a number of software customers. So Kelley, here's to you.
Thank you, Lauren. Hi, everyone. My name is Kelley Bodnar-Battles, and I'm the CFO of Host Analytics. For those of you who don't know Host Analytics, we are the world's only SaaS provider of a full corporate performance management suite. And by corporate performance management, I mean consolidation, budgeting, scorecarding, dashboarding with a whole layer of reporting on top of it. I'm very excited to be here today to talk about a couple of topics about which I feel very passionately. The first is fact-based decision-making and really the discipline that can be provided here, how it can help not only a company's success but also help elevate the role of a finance executive. And then secondly, tools that can help in this fact-based decision-making, SaaS, corporate performance management tools, and as Lauren's been talking about, the importance of having good both internal and external data as context for your analysis as you go through this process. So I will skip over this slide and jump right into background. So we all come to the table with biases that that shape our perspective, and my background definitely has shaped my beliefs and biases around corporate performance management and the importance of rigorous fact-based decision-making. I've had the great fortune to study and work at some world-class institutions. I divide my career into two parts: the keep your option to open years and the I finally figured out what I want to be when I grow up years. The first keep your option open years were just general. I guess the theme I'd say is general roles that were very focused on training employees to be, or students to be, data hounds, and it really taught me the importance of letting the data, the importance of the data as well as the importance of using it to promote rigorous fact-based decision making. And I have to say that at McKinsey I really learned and saw a wide variety of companies who could get this right without McKinsey, who got this right with McKinsey, and who just couldn't get it right. And it really, there was a wide variety or you could really see the impact of getting this right and the success of the companies. And then the second stage, operational finance. So I had the great pleasure of being in a company called Ironport Systems that was bought by Cisco, and now I'm the CFO of Host Analytics. And in operational finance, people joke around the companies that I've been at in these roles, but my mantra is truly let the data set you free. Every company, no matter how well run, how well it's doing, faces potholes in the road. And I truly believe that using the data and promoting fact-based decision making can provide a common language to get at these decisions and to kind of, as Lauren alluded to, get away from the politics, get away from the anecdotes, and really use the data as a common language to approach this decision-making process. I believe that every company hits the potholes, and it's how you get through those potholes defines you. And I think this process and this topic can really help you. I think we as finance executives, I believe that the majority of you out on the line are finance executives. We as finance executives are in a very unique role as the keeper of the data. And our challenge is to use this data and other tools to help to evolve our role, to get a seat at the table and use this data and use these processes to help drive true corporate performance. So the evolving role of finance. So if you think about finance and with the analogy of kind of on the scale of Cro-Magnon man to modern man, we all know the stereotypes. Cro-Magnon man here is the bean counter, the reactive purveyor of rigid data and processes, and at the end of the day, a reporter of basically history, right? And the modern man analogy is a true business partner who's proactively providing real-time, flexible information that truly allows the company and the finance team to drive true business results. And it is my fundamental belief that both SAS and CPM, corporate performance management, and the use of this valuable internal and external data can be key enablers to help this role, to this evolution of our roles. So, and if you don't believe me, if an analyst says it, it's got to be true, right? So I have a couple of quotes here that I really like. The first one from Bill McNee, the founder and CEO of Saugatech Technology. A lot of words here, but I like what he's saying. The most successful CFOs will enable decision-making not only through the delivery of timely and accurate information in context, so real-time, in context, but also with an appreciation of the type and level of decision risk associated with each scenario under consideration. So real-time data in context so that you can assess your risk and make the best decision for the company. Second quote from Brad Richmond, who is, I think, really an inspirational CFO, a very forward-thinking CFO of Darden Restaurants. Today's CFOs must balance the traditional responsibilities with the ability to provide analytical truths and points of view that shape overall strategy. So let's talk about the tools. So we've talked about the evolution of the roles. Let's talk about the tools that are available to you. And the first one, I'm going to talk about three: corporate performance management applications. I'm going to do a quick discussion on that. Secondly, SAS, and I think many of you are users of SAS, so we'll cover that really quickly. And then we'll talk about data and just the importance of the single source of truth, both internal, external, and how getting these three things right together can really make a big difference for your company. So first, corporate performance management tools. So I could spend 10 minutes on this slide alone. I'm not going to because I don't have 10 minutes. I'm sorry if I'm rushing a little bit, but I've got a lot of content here to cover. But the net is that we as finance executives are in a good spot here because we're really kind of riding the wave of today's third-generation applications. The original applications in corporate performance management came out in the early 90s, and they were really basic Excel or early applications that were discrete process improvements focused on the finance organization only. The second generation allowed more kind of multi-dimensional data management and more tailored modeling management, but still were finance only, not a lot of collaboration, not a lot of complexity. Today we at Host Analytics believe that we're leading this kind of third generation where you combine the features available in corporate performance management, the basic features, you add complexity around scenario modeling and strategic mapping, strategic decision enablement, and you layer on SAS where you allow then true collaboration not only within the finance organization but outside the finance organization, cross-functionally across the company. And what these tools and this access, this availability, this single source of truth allows you is, again, this evolution from being a kind of a basic purveyor of points of truth to a cross-functional driver of corporate performance management using tools and data to make better decisions across the company. Okay, so that's a quick, quick view of the evolution of the tools. Now let's talk about SAS and what it can do for you. And before we jump on this topic, I want to give a little context. And a lot of these slides are typically build slides, so excuse the kind of data hitting you at once. But basically, to understand SAS in terms of context setting, it's really important to understand two characteristics of SAS. First, the economic model. Because SAS is priced on a term-based subscription model, renewals are the lifeblood of SAS. And so good SaaS companies, or SaaS companies in general, live or die by their ability to keep customers happy and get those renewals in, because we don't typically make money in the first year of a relationship with our customers. And so there is an ongoing incentive for SaaS vendors to invest in customer satisfaction. It's the first one is an economic incentive to keep customers happy. The second thing that you need to understand is the delivery model. So if you think about the life cycle of a software product, from creating the software, distributing it, upgrading it, installing it, patching it, supporting it, providing reports for it, and all the backup kind of disaster recovery and IT infrastructure required, all the way down to actually using the software. SaaS companies allow customers to be customers and vendors to be vendors. So if you look at the right side, the green arrow, learning, configuring, and using the application, in the SaaS world, that is what you as a customer will do. The blue arrow is what we as vendors, SaaS vendors, will do. We believe that this allows, again, customers to be customers and vendors to be vendors. Now, the red words in the blue arrows are typically things in an on-prem world that the vendor is not fully responsible for, and in some cases not responsible for at all. And so, again, remember, we are incented, as SaaS vendors are incented by the renewal model to keep customer satisfaction levels high, and we're also allowing you to be a true customer, and we're taking care of the vendor elements of the relationship. And so now let's talk about the value that a SaaS application can provide. And again, this is a slide I could spend a lot of time on, and it's typically a build slide. But just to simplify and kind of cut to the chase, there's three parts to this pyramid. The top are things that are kind of table stakes. You've got to be easy to use. You have to be configurable or customizable. You have to perform, and you have to have the feature set that your customer requires. This is driven by the vendor. It's agnostic when it comes to is it SaaS or on-prem, right? The second layer, lower initial costs, lower ongoing costs, and access, the ease of access to functionality and upgrades. This is also still driven by the vendor, but SaaS or the cloud enhances the offerings here. It is just fundamentally cheaper to configure a SaaS application versus customizing heavier on-premise applications. It is fundamentally cheaper to maintain SaaS applications over time, both from a training point of view, from a FTE point of view, and definitely from an IT point of view. And the beauty of SaaS, where we have we have a single code base provided on a multi-tenant basis, is that we're allowed, because of the simplicity of having a single code base, and we are able to provide fast, free access to the latest functionality and upgrades. And so you don't have to wait a year for the latest version of a product. You don't have to spend hundreds of thousands of dollars to actually, and team time to upgrade. So again, these are things that are driven by the vendor, but the cloud really enables this value. And then finally, at the bottom part of the pyramid are things that are absolutely driven by having a cloud or SaaS application. And so I could spend a lot of time here, but I won't. But at the core, having a SaaS application allows for things like real-time external benchmarks and drivers to be loaded on a real-time basis into your application. So examples are having OPEXEngine's data provided on a real-time basis to your reporting engine so that you can produce simple actuals and budget versus benchmarks instead of just actuals versus budget. Things like currency rates being automatically uploaded into your application. I'm sure many of you have somebody on your team that actually keys in currency rates at the end of each month's close to make sure that your consolidations happen accurately. Because of the collaboration allowed by a SaaS product, we are able to get the best people on the right problems. You can decentralize the work. You can have your marketing people working on the marketing part of the budget and making sure that it's tied to the key corporate drivers. And you end up having the ability to allow the integration of efforts with this collaboration, with having real-time access of all of your team members who are working on these processes and projects, and which allows you to avoid silos. You get better information and better decision-making and more accountability for the information and the data in the systems, because there's more access, more eyes looking, more inputs into this single source of truth. And then finally, the last one, which I feel very strongly about, is the beauty of a SaaS application is the vendor can watch the activity that's going on with the customer process or application. And so we're able to monitor performance and allow real-time customer support if we see things happening. We have examples at Host Analytics where we've seen latency in a customer. We've diagnosed the latency as, say, a setting issue, gone to the customer, told them what's happening, provided a solution before the customer even knew that they had a latency issue. Again, this last third of the pyramid are things that are absolutely driven by having a SaaS or cloud vendor. So I'm speeding right along. So talked about the evolution of corporate performance management tools, the beauty of the SaaS model. Now I want to talk about bringing it all together into a couple of kind of how this, if it's done right, can help you do your job more effectively. And I'm going to use several case studies. And first I'm just going to talk about how we use our tool and what we do at Host Analytics. And so again, this is supposed to be a build slide, but what I would have asked is if you think about the ecosystem of how you drive fact-based decision-making and how you think through the right metrics, the right frequency, the right context, the right reporting media, I would have asked you for some of these key dimensions on what does this ecosystem look like. But here's what it looks like at Host Analytics. We first look at what are the key drivers for your business, what do your stakeholders care about, and we divide our drivers into kind of corporate drivers and then functional metrics or drivers. And we think about those and use those differently. The next question is how frequently is it helpful to have this data and how frequently is it practical? It'd be great to have a full set of gap statements on a weekly basis, but those of you in the audience who are finance executives, you know that that's not practical. But there are some metrics that you need to see weekly, and even if it's not absolutely practical, you've got to look at them, right? So how frequently is helpful and practical? The next question is what's the right context? If you have actuals, as an example, how do you judge those actuals? Is it versus budget? Is it versus benchmarks like OPEXEngine? Is it over time, just looking at the trend? And then the last question on this kind of simplistic slide is what's the right way to look at it? So is it weekly dashboards? Is it monthly scorecards? Is it simple ad hoc reports that are query-based? Is it more structured, regular financial reports? Is it full automated report books? What's the right format? The beauty of this model and kind of underpinning here is because if you can get all your data into one source that's accessible to all, as we were talking about, the single source of truth allows you to focus less on is the data that we're using accurate and focus more on this is the data that we need to solve this problem. How do we solve this problem? Okay? So let's keep going, and I'm going to give some practical examples on how we use this data. So this is a slide that I literally have used on several occasions with our board, but it's something, it's a simple example of how to use benchmarks, right? How to use external as well as internal data. And so on this slide we have public companies, Salesforce, SuccessFactors, and NetSuite, looking at how they performed as they approached their IPO. So this is straight from Edgar Online S1 documents. Originally was a source document. And then we have OPEXEngine data for private SaaS companies, in kind of the mid-range revenue level. And then we have our budget results. And this is something that we are maniacal about. Every time we do a budget, every time we do a forecast, how are we tracking? How do we compare, right? And the questions that you ask yourself over time is, what are the right companies? This is, by the way, this is absolutely an art, not a science. But the types of questions, and there's no perfect answer, but the types of questions you ask to get around the proliferation of this data and to really hone in on what's the data that's most helpful is, first of all, what are the key metrics, as we talked about, and what's the right context? The right companies that are most comparable, why are they comparable? Where are they not so comparable? Because that may explain some of the variances. What's the right time frame for comparison? We could easily compare ourselves to Salesforce, NetSuite, SuccessFactors now, but they're large public companies, and we are still privately held. And so, it's an art, not a science. It's sorting through, and it's looking at what you've got, looking what your options are, and then iterating. Okay, so let's talk about some other examples of how we use this data. So, so these are simplistic, but very powerful if they're used correctly. So we at Host Analytics, it's funny, I was sitting through a presentation at a conference the other day that focused Chevron, and Chevron has the same approach. They use a business case for every material decision. Now, for them, a material decision is something that has greater than $100 million investment. So, now, we have the same mantra, although our threshold is a little bit lower. But we at Host Analytics are maniacal about having a business case for any material decision. Now, you have to ask yourself, what is your right threshold? What are the right tools to do this? When you're working on a kind of a cross-function advanced budget model, there are now tools, and we provide them as well, that allow discretionary initiative modeling within the context of your own budget. Now, sometimes you may not need that. Sometimes it is just a simple, quick and dirty Excel model that shows the pros and cons of a simple decision. And you, as an executive, have to decide what's the right approach. Is this do I really need to do? Can I get away with the simple one-off back-of-the-envelope analysis that gets me what I need, or do I need to go all the way to the opposite end of the spectrum, which is a full business case strategic plan, 10-page write-up with models behind it? And that's one size does not fit all, and I would never say for a small decision, go as far to the extreme. But the discipline of having that fact base and having that analysis provided for every decision I believe, is a powerful discipline to develop across the functions and not just within finance to get to this fact-based decision-making rigor. And also importantly, the data is important, but you've got to remember the qualitative factors in the human element as well. I don't mean to say that the fact base and the data is the kind of the end of the process. You've got to layer on the qualitative and human element as well. Another example is smart data, and we talked a little bit about this in the SAS pyramid, the value pyramid. But having linked benchmarks, having macroeconomic indicators linked directly as drivers into your budget process, having automated processes like the currency rate upload. This smart data, which we provide in a product called Decision Hub, you can get the data elsewhere, but the beauty is having it automatically linked. It's a time-saving feature that allows you to spend, again, more time on the decision-making and the presentation of the fact base and the recommendations, and less time on preparation of this data and the manual processes behind it. Okay, so other things to consider. And again, another build slide, a lot of data at once. But I'm a firm believer in the keep it simple, stupid principle, especially when you're just getting started with this stuff. I think when you hear a lot of the stuff at the first time, especially when it's presented by kind of people that are very advanced in it, it can sound like you need a PhD in statistics to make this work and to get this done. And that is absolutely not the case. I think the most important step is to decide this is important and pick a point and just do it. Start and launch, iterate, learn, and adjust. It does not have to be perfect to still be powerful and to make a difference. And an example in that pyramid, or that chart, the cube that I showed you around our ecosystem, we have iterated our metrics over time. The first set of metrics we started with was not the final set, and we're still not at the final set. They've gotten better over time, and the reporting on them have gotten better over time as well. But the important step is just put a stake in the ground and get going, because this will help you in your business. It will help you make better decisions. It will help your company perform better. So just do it. The third thing to consider is just is automate and link your data when possible. It is absolutely important for scalability. You may not need it now, but you will need it if you grow, and especially if you grow fast. So it allows for scalability, and it also gets back to the single source of truth. It provides data integrity. If you have multiple sources of the same data, that introduces opportunity for error and opportunity for, again, this reality of spending more, this possible reality of spending more time on actually verifying and validating data and less time on actually making decisions based on it. Single source of truth is key and related. Less thrashing, more time spent on problem solving, and it needs to be accessible broadly. Again, it comes back to how SAS can help you, but having it accessible broadly allows for a virtual feedback loop. It allows you to have more eyes on the data, more eyes using the data, more eyes trusting the data, and also if there is an error, more eyes catching the error. This builds trust in the data. It builds trust in the finance offering. It builds trust in what you're bringing to the table. And then finally, two heads are better than one. I think we as finance executives tend to think this stuff is all finance. It is and I believe this is a cross-functional discipline. It is a cross-functional muscle that the company needs to build, but that finance can provide the exercise equipment for. It can't be a siloed finance effort. Collaborating, spreading across the company, and enabling people to use it, entitling people to use it, and also requesting that people have accountability about this process across the functions leads to better answers and leads to better use of this whole process. Okay, so now we've talked about the tools, SAS, some kind of the data. Now let's talk about a use case. So, or kind of a specific example. So first, skipped a page there. Okay, back. Okay, so as I said, Host Analytics, we're going to talk about kind of what we do for our customers. So we're an integrated CPM suite, budgeting, consolidations, reporting, compliance, SaaS delivery, which means low cost of ownership, high ROI, rapid time to implementation, and as we were talking about, quick access to the latest functionality. We also have very good feedback on our support and services from our customers. So you can see some example customers. Now let's talk about the type of value that is provided if you can get this right. So this is a recent survey hosted by the Aberdeen Group. Over 200 CPM customers were surveyed. 30 of them were our customers, and their responses, the responses to the questions that the CPM users were provided were compared to best-in-class responses of best-in-class companies. Responses to similar questions from best-in-class companies, independent of their use of CPM. And you can see, so our customers were the only respondents who equaled or surpassed best-in-class in the benefits. And the thing that I really focus on is year-over-year change in profitability. Our customers' profitability grew at a greater percent than best-in-class companies. Our budget accuracy, our customers' budget accuracy was greater. These are the last two kind of bar charts to the right of the page. And you can see we had better accuracy or close accuracy. We were close on many things, but at the end of the day, we as finance executives are here to help drive more profitability and better performance in our corporate offering, our corporate performance. And it is my fundamental belief that these types of tools, especially if you're using a SaaS delivery application and you've got the right data in it, can really move the needle here. And so I wanted to give you kind of one case study. So a well-known name, Thule, makes the ski racks on the top of the cars and the luggage carriers or luggage racks for car tops. So Thule is a customer, and they had, this is going to sound familiar probably to many of you, but they had some very basic challenges. Late and inconsistent Excel, and this is on their budget process, by the way. Late and inconsistent Excel data, thrashing in meetings about data accuracy. Mid-year budget adjustments are very hard because of the cumbersome process that they followed, and they just weren't accurate in their forecasting. And they use Host Analytics for their budgeting now. They use what-if scenarios and kind of some of the advanced decision modeling that we talked about, and they do 12-month rolling forecasts with our tool, and they use our tool as the single source of their truth or their data. And the results are, much more efficiency in the process and the outcome of their budget process. But at the bottom line, they were able, and they said this, and you can see down below, they've been quoted in articles. The bottom line is they were able to save $1 million in inventory reduction through just improving their forecasting process. This is not rocket science, but it makes a difference. So, and one of the things that I like to say, I'm often asked when I speak at conferences and in such events, what's the true value of SAS? For me as a CFO, when I first came to Host Analytics, my team was able to put in 6 SAS applications in 6 months. An ERP system, we completely re-architected the way we use our own product, and then 4 supporting applications. 6 SAS applications in 6 months. That to me is the value of SAS. That a smaller private company has the luxury of using sophisticated tools and are able to do this. I don't have an army on my team. The fact that we're able to do this quickly, and not in series, but in parallel, that to me is the succinct answer of what's the value of SAS. So I have been talking fast and a lot. My last slide is just a wrap-up. So just to remember, as a CFO or a financial executive, promoting fact-based decisions throughout the corporation is critical in our evolving role. It is a muscle that companies have to develop cross-functionally. And it is my fundamental belief that the cloud or SaaS and CPM tools will help you realize this value. You can turn data into information and use, with sophisticated use of benchmarks, you add to your effectiveness, elevates the role quickly, it adds rigor and trust in the processes without increasing overhead, very importantly, and it expands collaboration and ownership across the company without increasing the associated infrastructure. So that is all I have, besides a big thank you for your attention and your time. I personally believe that the value of, I judge the success of such webinars or such meetings by the number of questions that I get. I know it's harder in a webinar, but I would love, and I know Lauren feels the same way, we'd love to get some good, meaty questions in our last 10 minutes. But thank you very much.
Ladies and gentlemen, if you'd like to register a question, please press the 1 followed by the 4 on your telephone. You will hear a 3-tone prompt to acknowledge your request. Your line will then be accessed from the conference to obtain information. If your question has been answered and you'd like to withdraw your registration, please press the 1 followed by the 3. If you're using a speakerphone, please lift your handset before entering your request. One moment, please, for the first question.
I know you guys are intellectually curious and you have many curiosities.
As a reminder, ladies and gentlemen, to register a question, please press the 1 followed by the 4 on your telephone.
Or you can also text us through the chat.
I'm showing no questions from the phone lines at this time.
I think we've covered everything so thoroughly that everyone is sitting back and overwhelmed with the data.
Well, I have a question for Lauren. Can you tell us a little bit about the options for size companies that OPEXEngine provides, how you stratify? One of the main, as I mentioned in my benchmarking slide, it is an art, not a science, and part of the art is figuring out kind of what stage, what companies, what are the right benchmarks. How does OPEXEngine help in that regard?
Yeah, it's a great question because I personally go back and forth to some extent on the question of what's more important, the timing of the data or the stage and the sort of model. And what I mean by that is, yes, we've just been through sort of an economic crash or whatever you want to call it. I'm trying to be careful about my words there. And so it did change the way a lot of companies were acting. And so, but at the same time, if you're a $10 million company, you typically will see certain operating ratios, and those are different than what you'll see for a $50 million company, regardless of whether it's 2010 or 2008. Now, in 2008, it was a pretty good year, and the SaaS model was catching on. We were probably in the second or third generation, however you want to define that. So companies were spending huge amounts of money, not getting to profitability, and having very high ratios. And definitely we saw in 2009 companies cutting back. But I still would argue that it's defined more by the size and also, again, the model of the company. So we break out the peer groups by the revenue groups, whether a company's private or public. But then, for example, we break them out by whether they're venture-backed or not venture-backed, because, again, even in the early days of SaaS or when we were first starting out 4 years ago, 5 years ago, I had a number of clients that were participating in the benchmarking that were bootstrapped, and so their growth rates were between 15-20% maybe in revenue growth, but they were profitable at 15 million, whereas I would, I'm sorry to say this if there's anyone that might question this on the line, but there are not that many venture-backed SaaS companies that have been profitable at $10 or $15 million, because the goal there is to grow and take over as much of the market as possible, because those companies are going to have a higher valuation, and the metrics that drive valuation are around revenue growth and those kind of things. But we also look at, for example, if you're selling large deals and average deal size is quite high and you're selling to hundreds of customers versus thousands and thousands of customers with a low cost of sales, you're going to have a different operating model. So we sort companies by that. We've sorted companies by the age of the company, but that, again, I don't find, based on the data that we've got, there's not a direct correlation between, for example, revenue growth and age of the company, or the operating metrics and the age of the company. So I hope that answers it a little bit more.
Thank you. Oh, I think we have a question from the chat. Let's see. We currently compute customer acquisition cost as a ratio of margin contributed to total sales costs. Margin contributed. What do you include and how do you calculate CAC? So that's a really great question. And I'll tell you, I've spent some time on this, and I've looked at other companies and what they do, and I've looked at the magic number, and it's all over the map. What we focus on is basically our cost of sales and marketing, our prior quarter cost of sales and marketing to our current current quarter bookings. But what I would say is, at the end of the day, no matter how you define it, the key is that you need to show improvements, right? And you need to know your drivers and watch your drivers, optimize your drivers, and show improvements. Because what's hard is then how you compare how you calculate to benchmarks. And so I think simpler is better, because benchmarks, as Lauren was talking about, it's hard to get detail in benchmarks. And so simpler is better, because the more simple the calculation, the better your ability to gather data from a lot of other companies. It's a funny story, because our board, really was kind of pushing me to take a look at the magic number. You guys need to use it actively. I did all this research on the magic number. And one of the questions I had about it is, what's the magic of the 0.75, which is the ratio? I guess if you're over, it's I can't even remember now, good, and if you're not, it's bad. And so I went and I calculated it for all the leading SaaS, or the big leading SaaS companies, and none of them were over the hurdle of the number as well. And so I think it just comes back to this is an art, not a science. You need to understand your business, understand your benchmarks, define what makes sense for your business. Don't optimize based on a formula that somebody else is giving you. Define what makes sense for your business. Try to match it with benchmarks, and then track the drivers and the improvement over time. I hope that answers the question.
I was going to throw in also, Kelley, on that question. I've talked to lots of companies. Some companies have very complex calculations of their expenses around what, how do you calculate customer acquisition cost. I think you can also, if you don't have a complicated calculation within your company, I think keep it simple, as Kelley says. And we typically work with a simple calculation, which is, let's assume that your sales cycle is either a quarter or it's 2 quarters. So take the number of new customers in, let's say it's 2010, and let's say you have roughly a 6-month sales cycle. So take the last 2 quarters of 2009 and the first 2 quarters of 2010 sales and marketing expense, and divide that by the number of new customers in all of 2010. And that's a very rough estimate of your sales and marketing expense per new customer gained. And you can vary it if you had, if you have a 3-month sales cycle, then just go back 1 quarter. And if you have a 12-month or 18-month, however you want to do it. But that's also sort of how the magic number is kind of calculated as well. So I think we're running up against the end. So thank you, Terry, for that question, and I'll turn it over to the chairperson.
Well, this is Rihanna. I just wanted to chime back in and say thank you to both Lauren and Kelley for all the valuable information you've provided today. And let the audience know that the webinar recording will be available to you following the close of the webinar. You'll receive a note as soon as that's available, so feel free to share with your colleagues. And thank you, everybody, for attending.